As an owner of Nvidia, what are you going to be scrutinising from the earnings?
Probably the most important forward-looking indicator for us are purchase commitments, because this doubled quarter on quarter in the last print. We went from 50 billion in Q3 to 90 billion last quarter, and this is essentially Nvidia locking out the supply chain. It's no surprise to all of us that the supply chain is very tight. We all hear about there not being enough memory to go around. TSMC silicon is a meaningful bottleneck. Optics is the same. Well, Nvidia have got between 2/3 and 3/4 of the supply of these key components through 2026 and into 2027. So we're expecting a significant step up again.
So to be clear, this is Nvidia's purchase commitments for its suppliers, or purchase commitments from hyperscalers for Nvidia chips?
Purchase commitments to suppliers, precisely.
Suppliers. Okay, so that for you is an indication that they have continued control over that supply chain.
Absolutely, because the risk going into this print and really throughout this year, we think, is not about demand. We do not think that is a risk anymore. This is solely a question about supply. 6 months ago, the market was focused on, are we overbuilding? The biggest risk now is, can we build fast enough to keep these earnings moving in line with the stock prices of the entire ecosystem?
Is Nvidia the way to play that, though? Or are some of the Asian memory suppliers the way to play it? Are they a cleaner, more monetizable kind of short-term play on how this AI build-out story is going to develop? Have we moved on from Nvidia to those kinds of companies?
Well, that's exactly what the market has done over the past 6 months. You look at the stock prices of SK Hynix, Micron versus Nvidia. And right now, we see more...
Is that the correct move?
Possibly in the short term. I mean, what the market has done, and we've all spent a lot of time doing, is following the bottlenecks. And over the past 6 months, those have been particularly in high bandwidth memory. Optics has been a key one emerging. But right now, the first derivative of the AI trade is now offering the most compelling valuation. And what we saw last quarter with Nvidia, and we're expecting to see continue throughout 2026, is a re-acceleration in their top line and on their bottom line. So Nvidia grew earnings about 50% last year on year. A very admirable achievement for a company of that scale. That's set to grow almost 100% this year. So right now, we will be trimming some of those Asian component suppliers because, yes, they are pure plays on some of these bottlenecks, but their stock prices also moved an incredible amount in the past couple of months.
Can I ask you about the life of some of the products that Nvidia puts into these hyperscaler businesses and others? Because the life of them and the period over which you depreciate them was something of a topic of conversation for quite a while. And you've got some interesting stuff in your notes about how the installed base becomes more valuable, not less. Explain how that can be possible.
Absolutely. We do think that there has been a misunderstanding about this because with NVIDIA architectures, they've now got a 1-year release cadence, and you buy the latest and greatest for training your large language model at the frontier. So that's Blackwell Ultra right now, moving to Rubin next year. What happens to Hopper, which was the prior architecture, even Ampere, which was 6-7 years ago, is that those N-1, N-2 architectures move to inference. And inference is when customers actually monetize these assets. So the ROI on these architectures, they actually go up, not down. And what we've seen right now, because we're in such an acutely demand-supply constrained imbalance, is that the prices for Hopper, they've gone up 35% year to date in the cloud.
Yes.
And the reason these get so more valuable over time is because they're optimized by software.
Yes.
And that's the whole CUDA ecosystem mode.
And one of the reasons why the market's attention switched to Asia was because of the memory story. We've also seen a lot of businesses trying to follow NVIDIA and trying to grab some of that market share, and some of them arguably trying to, managing to deliver higher profits as a result. But does NVIDIA need to worry about that competition or not at all?
Competition from
others who are trying to do what NVIDIA does?
Well, it comes down to locking out the supply, and so these.
It's not about Reuben and what it can do versus the competition.
Well, Reuben is definitely a massive leap forward versus competition, and what we saw from Google with the TPU last year, TPU version 7. This is very competitive with Blackwell. That does change with Reuben. Google moves to its next TPU architecture, and Reuben particularly moves to a more memory bandwidth intensive architecture, which is really, really crucial for inference. It's got about 2.4 times more memory bandwidth. And that's really, really important as we move into the agential era, which is highly more compute intensive.
Yeah.
It still does come down to capacity at TSMC and capacity with these memory players, and these ASICs players just do not have that same weight.
Everything costs a lot in this industry at the moment, and you're making that point very clearly. Are we as users, are corporates as users, paying the correct price for the AI that they are consuming at the moment? And if they did, would they use the same amount or would they use less? Are we being subsidized at the moment by the industry? And you look at the cash flow story for what we're using. And does that need to change?
So we expect the cost of AI to continue declining. I mean, the cost of inference right now, it's about 1,000 times cheaper than it was last year.
Right.
And you achieve this through technological progress. Every time NVIDIA moves to a new architecture, this brings down cost per dollar, cost per
The companies
per
are still
watt.
burning money.
The companies are burning money, but that's only because they're continuing to invest. I mean, the hyperscaler capex, if we look at this, it's slated to be over $700 billion this year.
Yep.
If there's a sort of 12 to 24 month hiatus between standing up this infrastructure and then actually producing revenues from it.
Yeah.
Andy Jassy sort of painted this clearly in his shareholder letter last quarter. And because the hyperscalers are seeing ROI on the capacity laid 2-3 years ago, they're continuing to invest, but more than what the revenues are. So we think the right metric to be looking at is revenue inflection, cloud revenue inflection, not free cash flow.
Okay.
We're expecting free cash flow to actually be materially negative for all the hyperscaler players next year. But the crucial point is that revenues are now inflecting. We saw this from Google, 63% year on year.